Welcome to Kopi Time, a podcast series on markets and economies from DBS Group Research. I'm Taimur Beg, Chief Economist, welcoming you to our 138th episode. And I will apologize in advance for the sound quality and the likely sirens of New York City police cars and fire engines in the background. So here goes. The annual meetings of the IMF and the World Bank held at Washington, D.C. last week were characterized by relief over global economic resiliency juxtaposed by heightened concerns about a variety of risks. There was an element of satisfaction among developed and emerging market government officials that the post-pandemic rebound-led inflation has largely abated, and the sharp interest rate increase phase has come and gone without causing economic growth to stumble around the world. This is a sharp departure from the case just 2 years ago, when there was near panic about the stickiness of inflation and the likely spike in unemployment that would be caused by necessary monetary policy tightening. It has, of course, turned out to be quite different. Labor markets have barely loosened and asset markets are buoyant, while goods inflation has dissipated considerably. China, a major source of commodity demand, has been on a slowing path, a contrast from the U.S. economy, which has been going strength to strength. This opposing dynamic has offered a degree of balance to the global supply-demand picture. A stable commodity price environment, despite escalating warfare in the Middle East, has also been a source of support. Global and ASEAN 5 growth is expected to remain stable between 24 and 25. In the IMF's World Economic Outlook forecast released during the meetings, global real GDP is expected to rise by 3.2% in both 2024 and 2025, while ASEAN 5 is expected to rise by about 4.5% in both years. Some slowing of China and India's economies could be also in store, about 50 bips each from 4.8 and 7% respectively, but overall, global consumption and investment would chug along as per the IMF. We think that it may be too early to declare victory over inflation or take comfort in the apparent resiliency from higher rates. Services inflation remains on the sticky side. Strong growth may spill over into higher prices, and the tensions in the Middle East could reach a tipping point. Already, in recent weeks, the overwhelming expectations of sustained rate cuts have begun to recede, with a great deal of uncertainty building up over how many rate cuts are possible next year. One or two more strong jobs numbers and higher than expected CPI prints could cause a sharp change in rates pricing for next year. The recent rise in long-term U.S. interest rates, which has resulted in mortgage rates rising as well, could be a harbinger for things to come. Higher rates could also materialize under Trump election presidency or Trump election victory, which could lead to expectations of higher U.S. fiscal deficit and erosion of Fed independence. That, plus Trump's tariff plans, could lead to firming of the USD, hurting some USD borrowing sovereigns, firms, and households. These risks will need to be assessed in light of the result of the November U.S. presidential elections. There was no shortage of concerns over the U.S., ranging from an increasingly untenable fiscal position, impact of higher tariffs on the rest of the world and to Americans, and a possible re-acceleration in inflation under a no-landing scenario. We even heard ideas akin to an EU-style border carbon adjustment tax on imports being floated by some Trump loyalists. While such things are less likely under a Harris presidency, no one that I met expects a meaningful improvement in the frictions characterizing U.S. trade and commerce vis-a-vis the rest of the world. There was, however, some degree of comfort with the U.S. outlook among many, actually, given the strong state of asset markets, a buoyant investment environment, commanding lead on the global AI race, and sound corporate and household balance sheets. As has been the case lately, the meetings contained a great deal of discussion and presentations on geoeconomic fragmentation, climate finance, and of course, China, from the so-called excess capacity charges to the scale and effectiveness of the ongoing stimulus measures, from the security environment, external and internal, to the China plus one dynamic. The arguments were unfortunately largely binary. There is a great deal of groupthink among DM economies about China, and the thinking is largely about threats and risks rather than opportunities and gains from cooperation. We expect this polarization to persist with more tariffs and other restrictive measures in the pipeline. The key is to do the best given that inevitable and adverse dynamic. This is where opportunities for EM are being seen. Supply chain relocation should help the likes of India, Mexico, Southeast Asia, and a few other countries. Investments from Western MNCs, as well as from Chinese companies, are being spread more widely around the world. It remains to be seen if this relocation process would take place without a drop in productivity displayed by China's manufacturing stack, but the choices to do so have been made, no doubt about that. Weaponization of the US dollar was another widely discussed theme. Surveys show that central banks are increasingly inclined to hold more gold and non-US dollar assets. Fintech solutions make deferred barter feasible, under which countries running trade deficits vis-a-vis China can receive RMB for what they sell to China and send those RMB proceeds back through the import channel. This is not a theoretical construct. It is an increasingly deepening phenomenon, especially in the Middle East. There are reasons for this. US-EU efforts to seize or freeze the assets of the central banks of Afghanistan and Russia, along with a multitude of restrictions over Western payment systems like SWIFT, are adding impetus for many governments to reduce over-reliance on the US dollar. There are already cases where central banks are repatriating their gold reserves custody from London or New York to their home jurisdictions. Now, reducing the reliance on the US dollar is akin to the de-risking of supply chain strategy that is touted a great deal. Just like the pandemic pushed companies to reconsider the efficiency-resiliency trade-off over nodes of manufacturing, similar considerations are at play with regard to the risks of holding US dollar assets. Alternatives like barter, purchase and localization of gold holdings, and adding euro or RMB to reserves are somewhat second-best options. They have some associated frictions, but they are now very much on the table. The extraordinary rise in U.S. debt issuance adds to these considerations in many corners of the world. All right, I'm going to switch gears a little bit, and I want to talk about a specific chapter that was published by the IMF. It was the IMF's Global Financial Stability Report, or GFSR, and it contained a very interesting chapter on the potential impact of AI and Gen AI on capital markets. The premise of the analysis was that AI and related breakthroughs have the potential to increase the efficiency of capital markets, and that includes trading, investment, and asset allocation, through assistive process automation and analysis of complex unstructured data. The report cited early evidence that these effects are already being felt in the financial sector. Financial firms are hiring a large number of AI talent. Developers are filing for patents, and these are up sharply, while pricing patterns and trading dynamics already show changes in some markets consistent with the adoption of these new technologies. Major gains from such a wave would materialize in the medium term. For the time being, the typical short-term use case for AI is the extension of existing trends in the use of machine learning and other advanced analytical tools. The IMF researchers argue in the report that AI may reduce financial stability risks by enabling superior risk management, deepening market liquidity, and improving market monitoring. But it's not all good. There are some risks to consider. Firstly, the risk is if trading strategies of AI models all respond to a shock in a similar manner, then it could create exaggerated price movements or market disruption. Also, there could be further migration of market-making and investments activities to hedge funds, proprietary trading firms, and other non-bank financial intermediaries, which could create a degree of opacity in the financial sector. Firms and governments should also take into cognizance the increase in operational risks, as there are only a handful of key third-party AI service producers. There's also the risk that AI-enabled bad actors could carry out cyber attacks and market manipulation with a far greater potency than anything we have seen so far. Global regulators are working on creating a framework to address these risks. Considerations include calibration of circuit breakers and a review of margining practices in case of rapid AI-driven price moves, as well as enhanced monitoring and data collection of the activity of large traders, including non-bank financial intermediaries. There will be an increased need to stay on top of dependency on data models and technological infrastructure. firms should be expecting regulators to demand risk mapping, covering internal, external data, interconnections, and interdependencies. So in conclusion, the IMF meetings did not bring forth any new ambitious calls to action. Key cyclical and structural issues remain the same, from sustainable growth to dealing with climate change. Thorny issues like increasing the voice of developing economies in the multilateral system remain on the sideline. The continuous erosion of a rules-based, free trade-oriented global system is noted, and those costs are highlighted, but there's little in the power of the well-meaning staff of the World Bank and IMF to push back against the trend. In the coming meetings, more of the same can be expected, and that's just about it. So that's it for today. Kopi Time was produced by Ken Delbridge from Spy Studios. Violet Lee and Daisy Sharma provided additional assistance. This podcast is for information only and does not provide any trade recommendations. All 138 episodes of Kopi Time are available on YouTube, as well as on all major platforms of podcasts, including Apple and Spotify. As for our research publications and webinars, you can find them all by Googling DBS Research Library. Have a great day.